if there is such a thing as a best approach out of all of these approaches, the best approach, I think, would be one where one focuses on multi-baggers, businesses that can be a 10x in 10 years or less, or maybe 100x in 20 years or less. If one focused purely on the multi-baggers, there are some advantages that come up with that approach. One advantage is that one doesn't have much in terms of taxes because you'll be holding businesses for a long time. Under most jurisdictions around the world, until the positions are sold, unrealized gains are not taxed. So basically, it gives you an advantage. And depending on the place on the planet that you practice this, sometimes the tax rates can be as high as, 40, 50%. Deferring that for decades or let's say 10 years or more is a huge advantage because you get a free interest-free loan from the government. So there's an advantage in terms of taxes with this approach. The second advantage is that you don't have this continuous treadmill of needing to, find something undervalued, then it gets, fairly valued, and then you sell it, and then you go look for something else. So the multi-bagger approach to investing has a few quirks, and it requires us to kind of change our mindset on a few fronts. So one of the changes one has to make is that traditionally when one looks at what Ben Graham, kind of the father of value investing, taught us, is that you buy something for well below what it's worth, and then as it approaches fair value, you sell the position, and then you go look for something else. But in the multi-bagger framework, what you would do is you would actually not particularly care if a position became fully valued or even overvalued. So for example, if you bought, a business for 30, 40 cents on the dollar, and it's growing, that dollar is growing. And at some point it's worth $1.50, for example. It's gone up more than 50% over what it used to be worth. But the stock is trading at $2, for example. So under traditional Grahamian approaches, you would sell that as you get past the $1.50 or whatever. But in the quest for multi-baggers, you would continue to keep it in your portfolio even when it became overvalued. You would sell it if it became egregiously overvalued. So one would need to distinguish between something that's overvalued and something that's egregiously overvalued. Let's look at some examples of businesses that might help explain kind of where this approach is coming from and how it might work and so on. So if we look at a business, let's say McDonald's, for example, McDonald's was formed in the business existed, but Ray Kroc took it over in the 1950s. I think they went public in the 1960s. It's been public for maybe almost 60 years since then. It's still growing. The number of restaurants, revenues, profits, etc. It's gone through some ups and downs over the years, but it's grown, and it's grown spectacularly. And I think from the time it went public till now, it's north of a 10,000 bagger. Every dollar you invested is worth more than $10,000. Not a 10 bagger or 100 bagger. Like a 10,000 plus bagger. And why did McDonald's do so well? It did well because in the early days, when it got going, there were a number of initiatives, a number of innovations that McDonald's had come up with. Some of you might have seen the movie The Founder. I think The Founder is, I think it's on Netflix. I'm not sure if it's on Netflix in India, but you might want to, I think it's a very good movie to see. There's also biography that got written on McDonald's called Grinding It Out. It's also a good book. It's a very old book, but it's a great book to read. There's another book which was written by the first CEO of Burger King. It's called The Burger King, and that's actually an amazing book as well. But basically, one of the early innovations McDonald's came up with was that everything they sold could be eaten without a fork or a spoon or a knife. There was no cutlery needed to, French fries, you could just take it from your hand and so on. The other big innovation was that it was served really fast. The production time. And actually, if you really study McDonald's internal processes and how it functions, it's kind of like a light manufacturing type operation. And the software and engines they use internally is like what you would use in a light manufacturing operation. And of course, like, for example, they were very specific about the way the French fries should be with the Russell potato. So in fact, like, for example, when McDonald's enters a new country, like India or Russia, etc., it takes them 2 or 3 years from the time they decide to enter to the time they can open their first restaurant, because it takes a couple of years to train the farmers and generate the supply chain for the right kind of potatoes and such. So it takes them sometimes more than a couple of years just to open the restaurants and such. But the interesting thing about something like McDonald's is that almost all the innovations they came up with, there were a lot of copycats. And there were many businesses that came up that cloned or tried to clone what they were doing. And in general, fast food became a huge industry with many players. It wasn't just burgers. We then got a big kind of growth in pizzas, chicken, KFC. So, a lot of different entrants came in. And also, I think on the consumer side, it also changed in terms of what the frequency people were looking to eat all of this stuff. But anyway, even with all of that competition, McDonald's was able to establish a brand. People knew before they went into a restaurant, any McDonald's, what to expect. The kind of standardization and consistency, the cleanliness, the consistency, and the nature of the service worked. So that particular moat has been going strong for 60 years. There aren't really any signs that say that the moat is eroding and may not do so well in the future. They continue to do well. And it's a very high return on equity business. So basically, if you think about a franchised McDonald's, where an entrepreneur, does a contract with the McDonald's Corporation. So in a franchise situation, in the United States at least, a lot of the real estate is owned by the McDonald's Corporation. And the rent that is charged to the franchisee is a percentage of sales, like maybe around 4% of sales is the rent. So if you think about the rent that McDonald's charges its franchisees, it's kind of automatically inflation indexed, just goes up with inflation. They also charge a franchise fee, for the right to use the brand, etc. That might be another 4% or so. And then the franchisees also buy a lot of the products they need from McDonald's. And usually what McDonald's and a lot of the other franchise type operations will do is they tend not to focus on making money on the products. They tend to focus on passing that through. But you have the two main engines of the franchise fees and the rent, which might be something like 7-8% of the top line. So if you look at it from the McDonald's Corporation's point of view, a typical McDonald's in the US might have something like 2 or 3 million in annual sales. And the McDonald's corporation might get something like, 150, 200,000 a year from that location. The capital they have to put up against that is almost non-existent because it's the entrepreneur who's, paying for all the capex and the maintenance capex and all of that. So it's a very capital light business. So the three legs that we need, I think Chuck Akery called it the three-legged stool. The three legs that we need for these long multi-baggers is, first of all, the core economics of the business should have very high returns on invested capital, ideally without the use of debt, right? So you basically, like McDonald's doesn't need to borrow money to make a lot of money. The second is that we want very high integrity management, and we want insider ownership, kind of alignment of interest, where there's a smart entrepreneur or someone or insiders who own it. So they've got incentives. And the third is that we want a very long runway. So where we can see that this thing can go on for a very long time. And I think that when we, if you were to pick up the annual report of, let's say, Walmart, for example, Walmart went public, I think, in 1972 or something. It's like been public for like 50 years. If you picked up the annual report of Walmart, let's say in 1980, for example, a few years, 7-8 years after they went public, you would see that they've got very superior economics at the store level, that they generate high returns on equity. It's a business that does well, very, very rapid turnover inventory and so on. And you would also see that it was embryonic in the sense that large portions of the United States at that time, 1980, still did not have a Walmart. For most people, you could not get to a Walmart within, 10, 15 kilometers of your home. So you could see that basically this business could actually, if you just looked at it in North America, there was a lot of room to grow. And what we've seen with McDonald's is that or Walmart is that it wasn't just a US story. It was a global story. So Walmart has, opened up in other countries and done well. And, we could look at other businesses like, let's say, the Coca-Cola company. The Coca-Cola company was formed about 130 years ago. And that moat is still growing after 130 years. And again, the unit economics are extremely attractive because the Coca-Cola company typically doesn't do bottling. They sell the syrup. So they have, these plants which they don't even sell the syrup, they sell syrup concentrate. So basically, it's almost like a software business where, if you're spending 5 or 10 rupees on a Coke, the Coca-Cola company might get like 8% of that. And they would have very little costs against that. So again, it's very similar to McDonald's in terms of economics. So basically, there are businesses, different kinds of businesses. You can look at a business like MasterCard or Visa or American Express, and they have similar attributes where you have very high returns on invested capital. You have a very long runway, and you have high integrity management with insider ownership and so on. So if one pursues these, now, the nature of capitalism is that everyone wants to own these kinds of businesses. Once these kind of moats and, runways, etc., are well known, the businesses get priced to perfection. And they may not be available at a cheap price. And so, for example, if we look at a business in India, like DMart, for example, and DMart, similar model to Costco and Aldi outside India. And DMart is very embryonic today. There's very few DMart stores in India relative to what could possibly be their penetrations in 10, 20, or 30 years. But the market recognizes that. And so DMart trades at, huge multiples. It doesn't appear optically cheap. But the interesting thing is that if the runways are really long and they actually end up being runways that go on for, several decades, then even an expensive looking price can end up being a great value investment. But I think that as value investors, we have to also have a good dose of skepticism in how we approach these things. So we can't always assume that everything's going to go to the moon in terms of size and growth. And the nature of capitalism is that there will be a lot of competition that will try to go up against those moats. But I think that if there's a quote from the Upanishads which goes something like this: "As is your wish, so is your will. As is your will, so is your deed. And as is your deed, so is your destiny." And then kind of the punchline is your deepest desire is your destiny. So going back, to what I started with, if you said, I want to focus on 50-cent dollar bills, and that's your deepest desire, you will find those. If you say, I want 20-cent dollar bills, you will find those too. If you say that I only want to invest in businesses that can go up 100 times in value in 10, 20, 30 years, you can find those too. So it's a matter of what you choose to focus on. And as long as you're willing to put in the work to sift through company after company, with the framework that you're interested in. So in the case of the multi-bagger framework, there are just three things that matter. And then the fourth is the price, obviously. So if a business doesn't generate high returns on equity, you're done. You don't need to spend any time on that. If the business needs a lot of debt to grow and generate high returns on equity, you would also be done. You don't even need those. If management quality or ethics is a question, you're also done. You don't need those either. And so just if you look at the businesses that generate high returns on equity, that alone would wipe out large swaths of businesses. And then, you get to the runway, right? So DMart will be a lot larger in 10 or 15 years than it is today. I think that's a pretty easy bet to make. That statistically, I think the odds are high that something like DMart might do well. We could make that statement about private sector banks in India. Private sector banks in India might be like a third of the banking pie in India today. And maybe in 10 or 20 years, it might be half or 2/3 of the pie, for example. And the pie itself will have grown. So there are things that we could hang our hat on and then kind of take it from there. So basically, I think that if you go down this path, which is the multi-bagger path, the interesting thing is that and all value investing, there are a couple of data points. John Templeton used to say that the very best value investor or analyst will be wrong 1 out of 3 times. Like 33% error rate is the lowest error rate for the very best practitioner of the art. If you were a kind of brain surgeon and you had even a 3% error rate, there might not be too many people coming to you for brain surgery. But I think in terms of value investing, you could be wrong half the time. And I think I've probably been wrong close to half the time and still end up with a phenomenal track record. So, and especially if you focus on the multi-baggers, companies that would go up 10x or 100x, basically in a lifetime of investing, if you ended up finding just 2 or 3 or 4 100 baggers at the age that you're at right now, that's all you need. In many cases, if you just found one, that might be all you need. And so we have all this time. And on the other end, we just need to find things just once. Don't even need to find them that many times. When I started my journey value investing about 27 years ago, 94, 95. In the first 5 years, when I was not running my funds, I was just running my own money. I started with about $1 million in 95. By the time in the first 5 years, I had 200 baggers in the first 5 years itself. And then I think from 2000 to 2022 now, I haven't had any 100 baggers. But I think that there might be some more in the future, some that are kind of still hopefully going through their journey. So you don't need very many of them. A few of them can get you to the promised land. And I would say, when I look back, a rather sloppy journey as an investor, because I was trying all these different things. If in 94 or 95 I had done what I am telling you to do now, or suggesting what you should do now, I think I would have done a lot better than how I've done. So if I had purely focused 10 or 100 baggers, I think the results would be vastly better. I remember in January 95, when I had the $1 million, I had mostly invested in the US markets. But I had an interest in the Indian markets as well. And I thought there were 2 or 3 areas where it could do well. And I decided to put 20,000 out of the $1 million, just 2% of the portfolio into India at that time. And I opened a brokerage account. And so just my own money. So I opened an NRE brokerage account with Kotak. I decided to put half that money, $10,000, in one stock, which was a IT company. And I was in the IT services business at the time. So I knew this business really well. Satyam Computers, which at that time actually was a pretty honest company. They kind of went wayward, I think, in terms of their ethics about 10, 12 years after that. But in 95, they were a clean company. So I put 10,000 into Satyam and in 95, and I think by the time it was 2000, it had gone up 150x. The 10,000 had become $1.5 million, approximately 1.4 million or something. And then the remaining 10,000, I put into 3 other stocks. I bought 2 of the courier companies that were listed in India at the time, Blue Dart and Skypack Courier, because my perspective was that the Indian Postal Service was just hosed. And if you really wanted to get a package from point A to point B in India, you really had to rely on private people to get it for you. I don't think the Postal Service was reliable. And so I thought that these businesses that were focused on that would do quite well. So I was just going to make 3 investments, actually, half in Satyam and then half in these other 2. And then at the last minute, I was also very impressed with Kotak because I was just very impressed in dealing with their people. And so I decided to split the other 10,000 3 ways, one about 3,300 in Kotak and 3,300 in the other 2 businesses. So when this 10,000 became 1.4 million or whatever in 2000, the other 3 businesses had done nothing for 5 years. They was pretty much sitting close to what I had paid for them, like no movement for the most part. It is not realistic to think that if you put $20,000 in the Indian market and you get, you know, 1.4 million, something like a 70x, there's still some meat on that bone and there's still some juice to be extracted, if you will. So I said, this is a pretty good result. And for no really good reason, in 2000, I sold the other three stocks. And I told Kotak, sell these stocks and just send me the money back. I basically liquidated the entire Indian portfolio in 2000. There was no really good reason to sell Blue Dart or Skypack or Kotak. No particular reason that I had to do that. Kotak from 2000 till now is about a 500x. Blue Dart is about a 300x. Skypack went kind of backwards. I think eventually went bankrupt, but it was down like 90% or something. So basically, there were massive home runs. There were two massive home runs, which, like I said, I there was no reason to kind of make that decision to sell, but that's what happened. And, I missed those two rides. But even with the sloppy nature and kind of stupid analysis that I did in those sell decisions, the end result was fine. And the remaining 980,000 that I'd invested in the US over the next 4 or 5 years, by 99, 2000, it was about 13 million or so. So that had gone up quite a bit because one of those bets had gone up 100x. 100,000 became about 10 million or so. So anyway, the thing is that even with a lot of sloppiness, what I'm saying is that basically what when you look at that investing that took place then, just the two bets that were 100 bagger were responsible for like 80, 90% of the returns. It didn't matter. The rest didn't matter if it all went to zero. The results would have still been great. And so that's the nature of this multi-bagger type investing, is that it can tolerate a very high error rate. And of course, your objective as an analyst should be to try to keep the error rate as low as possible. In 2019, I was visiting Istanbul for the second time. And Turkish market actually, I think, is the cheapest market in the world because they've got just a lot of crazy macro things going on in the country, very high inflation and weird policies, and everyone's exited and so on. In fact, Turkey reminds me of the Indian markets maybe in the early 90s or so on. And I ran into this business on my second trip in 2019, where the market cap was $20 million and the liquidation value was more than $600 or $700 million. It was actually a dollar bill trading for 3 cents, which I don't think, it never happened to me before then. So in the previous 24 years of investing, that never happened. And I think till I leave planet Earth, I don't think it'll happen again. But basically, if I look at this business, which I bought at, 3 cents on the dollar, like the 20 million market cap, I was surprised with the volumes. Pabrai Funds owns 1/3 of that business. And we pretty much got 1/3 of the business for like $8 million or something. If the business did not increase in value at all, but it got to fair value at some point, we would have a 30x return, 30 or 33x or something. But now we've owned the business for about 3 years. They've actually increased value of the business quite a bit in the last 3 years. And it's run by phenomenal people, really good capital allocators. And I think they will increase the value of the business quite significantly in the years ahead. So having learned my lesson from Kotak and Blue Dart and so on, the only thing I need to do with this business is do nothing. Just sit there and spend time talking to students like you so that the time is used up and not used to sell things. Hopefully 20 years from now, we still own that business. So if that business tripled in what it's worth, the value, like, was 600 million or something, let's say it became 2 billion, we would have 100 bagger. And I think it can triple its value in maybe 5 or 10 years. And it can keep going after that. I mean, the two people running it, they're not that old. So I think they could keep compounding for a while. And so when I look at kind of that particular business, and it's a small part of the portfolio today, it's gone up, I think in the last 3 years, it's gone up like 5-6x or so. So it's gradually moving towards its value and so on. But I'm just saying that the nature of these 100 baggers is that this one business could become bigger than everything else in the portfolio, even though we made such a small bet with it.